every April, something quietly terrifying happens across America. Millions of people sit down at their kitchen table, open an envelope from their employer, stare at a form covered in numbered boxes and codes they don't understand, and feel the exact same thing they felt last year: lost, confused, slightly afraid that they're about to do something wrong and not even know it. And they're not alone. In 2026, a survey of 2,000 American adults found that more than 1 in 5 people, 21%, say they flat out don't understand the tax process. Almost a third believe they've missed deductions or credits they were entitled to. And 1 in 4 say tax season actively damages their mental health, not their bank account. Their mental health. We're talking about paperwork creating genuine psychological distress in millions of people every single year. Here's the thing though, that confusion, it's not your fault. Tax forms were not designed to be understood by the people who fill them out. They were designed by a system that assumed you'd either have a professional to guide you or you just figure it out by trial and error for 40 years until you retired. Neither of those is acceptable anymore. So today, we're going to fix that. 8 tax forms: the W-2, 1099, 1040, W-4, Schedule C on the US side, and the P-60, P-45, and SA-100 on the UK side. Explain the way they should have been explained to you the first time you ever had a job. Simply, clearly, with actual stakes attached, so you understand not just what each form is, but what happens when you get it wrong, and exactly what you gain when you get it right. I'm your Vault Keeper, and by the end of this video, tax season is never going to feel the same way again. Let's unlock it. Let's start with the form that most people have seen, but fewer people actually understand: the W-2. Picture this. It's late January. An envelope arrives from your employer, or a PDF hits your inbox, and inside is a document that looks like it was designed specifically to be confusing. Boxes numbered 1 through 20. Codes, dollar amounts, multiple copies. What is all of this? Here's what it actually is. The W-2, officially called the wage and tax statement, is your employer telling the IRS and you exactly how much you earned and how much tax was already taken out of your paycheck during the year. That's the whole thing. Box 1 is your total taxable wages. Box 2 is the federal income tax that was withheld from your checks throughout the year. Boxes 3 through 6 cover Social Security and Medicare. Every number on there is a piece of the story of your work year, translated into a language the IRS can verify. Here's what makes the W-2 genuinely important beyond the obvious. Your employer files this same form directly with the IRS, which means the IRS already knows what you earned before you even file your own return. If the numbers on your return don't match the W-2, that mismatch gets flagged automatically. In 2026, the IRS identified more than 1.2 million potential math errors and discrepancies during filing season. Most of them were preventable. Many of them started with someone misreading their own W-2. Your W-2 must arrive by January 31st. If it doesn't, contact your employer. Don't wait. Don't assume it's coming. That one document is the starting point for your entire tax return. Now here's where it gets more complicated and more consequential for a growing number of people: the 1099 family. If the W-2 is the document for people with traditional employment, the 1099 is the document for everyone else: freelancers, contractors, gig workers. Anyone who drives for a rideshare app, writes copy between jobs, sells anything online, earns investment income, or pulls from a retirement account. If money came to you outside a regular employer payroll, a 1099 is how that income gets reported. And here's the critical difference that trips people up every single year. With a W-2 job, your employer withholds tax from every paycheck. The money goes to the IRS before you ever see it. With 1099 income, nothing is withheld. The full amount lands in your account, and suddenly it looks like more money than it is, because none of the tax has been taken out yet. That check for $5,000 from a freelance project, you'll owe federal income tax on it, plus self-employment tax on top, which we'll get to in a minute. The 1099 comes in several versions depending on where the income came from. The 1099 NEC is for freelance and contractor work. The 1099 NE is for bank interest. The 1099 DIV is for investment dividends. The 1099 NE is for retirement distributions. The 1099K is for payment platforms like Venmo, PayPal, and Stripe. In 2026, the reporting threshold for the 1099 NEC increased to $2,000, up from the old $600 threshold that caught many people off guard in previous years. If you've ever done any kind of side work and thought it was just a small amount, I don't need to report it. That's one of the most common and costly assumptions in personal finance. The payer already reported it. The IRS already has the number. Not including it on your return isn't just a mistake, it's a mismatch the system will catch. All of those forms, W-2s, 1099s, they're inputs. They feed into the one form that actually determines what you owe or what you get back. The Form 1040 is the U.S. individual income tax return. It's the master document. Every source of income you receive during the year goes in here. Every deduction you're entitled to gets subtracted here. Every tax credit you qualify for gets applied here. And at the end of the calculation, you find out whether you already paid enough tax throughout the year, in which case you get a refund, or whether you underpaid and now owe the IRS a check. For most people with straightforward situations, one W-2 job, no major investments, standard deduction, the 1040 is actually not as intimidating as it looks once you understand the flow. For 2026, the standard deduction is $15,000 for single filers and $30,000 for married couples filing jointly. That means if your deductions don't exceed those amounts, you don't need to itemize anything. You just take the standard number and subtract it. The due date is April 15th. If you need more time, Form 4868 gives you an automatic extension to October 15th. But here's what people misunderstand about that extension. It's an extension to file, not an extension to pay. If you owe tax, the payment is still due April 15th regardless. File late without paying, and interest and penalties start accruing immediately. Before the 140 ever gets filled out, though, there's a form that most people only think about once on the first day of a new job and then never revisit again, even when their entire life changes. The W-4. The W-4 is the form you give your employer when you start a job to tell them how much federal income tax to withhold from your paycheck. Most people fill it out on day one of a new position, hand it to HR, and forget it exists. And that's exactly where the problem starts. Your life changes, you get married, you have a child, you start a side business, you go through a divorce. Each of those events changes your tax situation meaningfully, and if your W-4 still reflects your circumstances from 3 jobs ago, your withholding is probably wrong. Either you're having too little withheld, and you'll owe the IRS a potentially painful lump sum in April, or you're having too much withheld, which sounds harmless but means you've been giving the government an interest-free loan out of every paycheck all year. The modern W-4 was redesigned in 2020 to be more intuitive. It no longer uses allowances, a concept that confused people for decades. Instead, you directly indicate your filing status, whether you have multiple jobs, any dependents, and whether you want extra tax withheld. Anytime your life changes in a significant way, it's worth 10 minutes to update it. Now, for the form that most traditional employees never need, but that every freelancer, contractor, and self-employed person absolutely cannot afford to misunderstand. Schedule C. Schedule C is the form where self-employed people report business income and, crucially, business expenses. The net result, income minus expenses, is your taxable business profit, and that number flows directly onto your 1040 and triggers an additional tax called the self-employment tax, which sits at 15.3% on top of your regular income tax. Here's what nobody tells you when you go freelance or start a side hustle. You're not just an employee anymore, you're simultaneously the employee and the employer. And that means you pay both sides of Social Security and Medicare. A W-2 employee pays 7.65%. You pay 15.3%. That's the cost of working for yourself that a lot of people discover for the first time when they see their April tax bill and nearly fall off their chair. But here's the other side of that coin. Unlike W-2 employees, self-employed people can deduct legitimate business expenses directly from their income. Your home office, your mileage, your equipment, software subscriptions, professional development, health insurance premiums, these deductions can significantly reduce the profit that gets taxed. But, and this is critical, the IRS scrutinizes Schedule C filers more heavily than almost any other category of taxpayer, precisely because there's more opportunity for error in both directions. Keep receipts, keep records, don't guess. If you found any of this useful today, and I genuinely hope you have, drop a comment telling me which of these forms you'd never really understood before. I read every single one, and knowing where people are helps me make every vault more valuable. Now, let's cross the Atlantic, because for UK viewers, the tax system works on a fundamentally different principle. and understanding that difference matters enormously if you're navigating both systems or preparing to move between them. In the United Kingdom, the default tax system is called PAEA. Pay as you earn. Your employer calculates your tax liability and deducts it from every paycheck before you receive it. The result, for most employees, is that they never need to file a tax return at all. The tax just happens, automatically in the background. It's a dramatically simpler experience than the American system for the average worker, but it comes with its own documents you need to understand. The P60 is the UK equivalent of the W-2. It's an annual certificate your employer must give you by May 31st each year, summarizing your total pay and total tax deducted under PAYE for the tax year, which in the UK runs from April 6th to April 5th, not January to December like the US calendar year. You don't submit your P60 to HMRC. It's for your own records, but you'll need it if you ever file a self-assessment return, claim a tax refund, or apply for a mortgage and need to prove your income. Lose it, and you'll be chasing your employer for a replacement at exactly the moment you need it most. The P45 is a document most people only think about when they're leaving a job, which is also the worst possible time to be learning what it does. When you resign, get made redundant, or retire from a UK position, your employer gives you a P45 containing your tax code, your total pay to date in the current tax year, and the total tax deducted so far. You take parts 2 and 3 of that document to your new employer so they can put you on the correct tax code from day one. Here's why this matters more than people realize. Without a P45, your new employer doesn't know how much you've already earned that tax year, so they'll put you on what's called an emergency tax code, which almost always means you'll have too much tax deducted from your first paycheck or two until the situation gets corrected. It's not the end of the world. HMRC will reconcile it eventually, but overpaying tax is always avoidable, and a P45 is the thing that avoids it. And now the form that brings everything together on the UK side, and the one that trips up the most people, because most UK workers never think they need it until suddenly they do. The SA100 is the UK's self-assessment tax return. For most employees under pay, this form is irrelevant. Your tax is handled automatically and you'll never see one. But if you have income outside of employment, freelance work, rental property income, investments beyond your ISA allowance, a company directorship, or income from overseas, you are legally required to file one. And here's where the shock comes in every year. For people who've just started freelancing or bought their first rental property, the UK system doesn't just ask you to pay the tax you owe this year, it asks you to prepay an estimate of next year's tax at the same time. These are called payments on account, and the first time you encounter them, after already paying a larger than expected tax bill, it can feel genuinely destabilizing. You thought you were paying what you owed, then the system tells you to also pay half of next year's estimated bill. Today, the online filing deadline for the SA100 is January 31st for the tax year that ended the previous April 5th. Paper filing closes earlier on October 31st. Miss the online deadline and you're looking at an immediate £100 penalty, with further penalties stacking up the longer you wait. The system is less forgiving than it sounds from the outside, which is exactly why understanding it before you need it is so much better than learning it under pressure. Here's the thing that connects every one of those 8 forms. Whether you're filing in the US or the UK, they're not obstacles, they're not traps. They're records. Each form is a piece of documentation that exists to answer a question. How much did you earn? How much tax did you already pay? And how much do you still owe? Or how much do you have coming back? That's the entire system, broken into separate documents based on where your money came from and which country you're in. The people who dread tax season aren't bad with money. They're not irresponsible. They just never had someone explain the logic underneath all of it. And once you see the logic, the forms start to feel less like an attack and more like a conversation, one where, if you know the language, you can actually make sure you're not paying more than you should. Remember, at the start, 30% of Americans believe they've missed deductions they were entitled to. That's not bad luck. That's not the IRS being clever. That's people sitting across from a system they didn't understand, handing over money they didn't have to. You're not doing that anymore. The vault is open. And now you know what's inside. Stay sharp, stay secured. I'll see you inside the next vault.